Hello everyone, welcome to Zine Rocks, a channel of education, entertainment and lots of tricks and ideas. I'm starting with a series of basic concepts in financial accounting. That means those who are interested in understanding the basic concepts in finance, the basic concepts of accountancy, you all can subscribe the channel, can press the bell icon, because in these few days I'm going to share some videos in which your concepts of financial accounting would be cleared. So let's begin with today's lecture. Frankly speaking, friends, I must have taken first the basic concepts in accountancy, the basic terminologies in accountancy, but here I am starting with the journal entries. The journal entries. What are the journal entries? Journal entries are the entries where the businessman records the transactions for the first time. It is the book of the original entry. Here we are going to apply some rules. So the videos on the concept terminologies, I'll be posting them after completing of the journal. So first let us try to understand the three golden rules of accounts. The first golden rule of personal account. Personal account. Personal account. What is a personal account? The personal account is related to persons. The personal account is related to group of persons. They are artificial, they are natural, they are representative persons. For example, if I say loan, loan is representing the person from whom you have taken it or you have given it. For example, it may be a bank, it may be a person, natural person. So loan is a personal account. Okay. Shahid is a personal account. Personal account. Next account is real account. The rule of personal account is debit the receiver, credit the giver. Debit the receiver, credit the giver. Debit the receiver, credit the giver. The next is real account. Real account are the accounts which are the accounts of the things, the properties, the assets which the businessman holds. For example, furniture account is a real account because it is related to an asset. Goodwill account is a real account because it is related to an asset. So real account. Debit what comes in, credit what goes out. Debit what comes in. Whatever comes in, you have to debit that account. Whatever goes out, you have to credit that account. So debit what comes in, credit what goes out. The next account is related to expenses, incomes, profits, losses, all those things which are fictitious, all those things which do not exist. These are expenses and losses. Okay, for example, salary. Salary is a nominal account. For example, rent is a nominal account. Rent is nominal, salary is nominal, wages is nominal, printing and stationery is nominal, electricity bill is nominal. There are many nominal accounts. The rules are debit all expenses and losses. Whatever are expenses and losses, you have to debit them. Whatever is your incomes and gains, you have to credit that account. For example, if you receive rent, that means the rent becomes your income. So rent account, that transaction has to be credited. But if you pay rent, that rent becomes your expense. So rent account in that transaction has to be debited. Okay, hope you understand. You will understand after I think 5 to 6 lectures on journal entries, basic journal entries, you all will understand journal entries properly. First, let us take 1, 2, 3, 4, 5 transactions. The first transaction is sold goods. The third transaction also, if you see, it is sold machine. Sold goods, sold machine. Here also sales is done, here also sales is done. But that activity is a normal activity, a day-to-day activity. But this activity is not a normal activity. It is not a routine activity to sell a machine. Hope you understand. Sale of goods is normal to any company. But sale of machine is selling of an asset. It is not a normal activity. In accountancy, you have to understand that there are two major things. One is, actually it is producing also, but one is purchasing and other is selling. Purchase and sales, these are the two most important activities. You are purchasing the raw material or you are purchasing the goods and you are selling the goods. You are selling the finished products. So whenever it comes to purchasing of goods, sale of goods, it becomes normal. That means that activity is a revenue activity. Revenue and capital. Capital activity or capital incomes or capital expense or capital incomes are those expenses which are incurred in a span of 10 years, maybe more than 5 years. That is a capital activity. For example, selling of machine is not normal. Selling of machine is a capital activity. So selling of goods is normal. It's a revenue activity. It's an income. It's a revenue income. Purchasing of goods is an expense. Purchase is an expense and it is a revenue expense. So whenever you hear the words purchasing goods, purchase or selling of goods, you have to understand that these two accounts will be affected. Purchase account and sales account. But if you hear purchasing of an asset, selling of an asset, then that asset account will be affected. Not goods account, not purchase account, not sale account. Suppose sale of furniture is given, don't write sales account. Selling of furniture is not a selling activity. Selling of furniture is furniture sold. So furniture account will be credited. Means furniture account will be affected. Is this clear? So let us start with the first transaction. Sold goods worth rupees 5,000. You are selling goods of rupees 5,000. You are selling goods. If I sell goods, then what I receive? I will receive cash. If I sell goods, what I receive? I will receive cash. Sale goods or sale of goods means sales account. The account which is affected here is sales account. Whether sales is personal, real or nominal, sales is a nominal account. It's an income. It's an income. And when we talk about any income, then that incomes are to be credited. Credit the incomes. Credit the incomes. Credit the incomes. So sales account is credited. And if one account is credited, the other account has to be debited. So which account will be debited? The next account affected in this transaction is cash account. Suppose we are selling goods for cash. Normally we don't do it for cash, we do it for bank. But suppose it is for cash. So cash account is affected. So when you sell goods, then you earn money. Cash comes in. Cash is a real account. Cash comes in. Debit what comes in. So one account is credit, the other account is debit. One account is credit, so other account is debit. So I will write in journal entries. The first column I have prepared is date, then particulars, the main entry, then LF. LF is a ledger folio. When the journal is posted into the ledger, it goes into the ledger. So which page number it goes will be written here, the debit and the credit. So first entry will be sold goods. Now it will be cash comes in, cash account is debit, leave some space here, to sales account. Sales account will be credit, that is 5,000. Okay, debit 5,000, credit 5,000. You have to write a narration being goods sold. Write being and copy the question. Being goods sold. So this is the first journal entry. Hope you understand. First journal entry. Sold goods. Cash account, sales account. Cash is a real account. Debit what comes in. Cash comes in. So cash account is debit. Sales is an income. Sales is credit. Credit all incomes and gains, nominal account. First transaction is over. Second transaction, purchase goods. Purchasing goods is a normal activity. So here purchase account is affected and cash account is affected, because purchase goods, obviously purchase goods for what? For cash. That means we are purchasing, and when we purchase, our cash will go out. When we purchase, cash will go out. When we purchase, cash will go out. When we purchase, cash will go out. So cash account, cash goes out. Cash goes out. Real account, cash goes out. And purchase is an expense, so debit all expenses. So purchase account is debit here and cash goes out. Cash account is credit here. So the second entry is purchases account debit to cash account. Cash account is credit. Amount is 10,000 debit, 10,000 credit, being being goods purchased. Hope this is clear. Next, number 3. Number 3. Number 3 is paid rent. Paid. Guys, you must understand there are two words which are very important. One is paid and other is received. Paid, what you pay? Cash. Received, what you receive? Cash. Paid means cash goes out. 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 So cash goes out, so cash is credit. Paid means cash goes out, so cash is credit. Paid means cash goes out, so cash is credit. Paid means cash goes out, so cash is credit. So here cash is credit. Paid, cash is credit. If you pay rent, so cash is credit. The next is rent. What is rent? Which account? It's a nominal account. Rent is an expense, nominal account. So debit all expenses and losses. If cash is credit, something has to be debit. Cash credit, so something has to be debit. So which account will be debited? Rent account will be debited. So here the entry will be rent account debit to cash account. Amount will be 5,000 being rent paid. Hope this is clear. Number 4. Received. When you receive, what you receive? Received is cash. Received is cash. Paid, cash goes out. Received, cash comes in. Received, cash comes in. Debit, what comes in? Cash is real account. Debit, what comes in? What you are receiving? You are receiving interest. Interest is a nominal account. Interest is a nominal account. What is the rule of nominal account? Debit all expenses and losses, credit all incomes and gains. So interest is an income, so interest is to be credited. So received में cash account will be debit to, I will write interest account. That is 2000. Narration being received interest. Okay everybody. One more entry I have missed. Sold machine. You have sold the machine. One more thing, the entries have to be in chronological order according to the dates. Now your dates was not given, that is why मैं कैसी भी entry pass कर सकता हूँ. Sold machine sold. That means which account is to be affected? Not sales account. Machine account. Which account? Machine account. Machine account is real account. When you are selling machine goes out. Credit what goes out. Machine goes out. Credit what goes out. Machine goes out. Credit what goes out. Machine goes out. So machine goes out. Machine is credit. So you have sold machine, so machine is credit. So what will be debit? Cash will be debit. Machine goes out, cash will come in. Machine goes out, cash will come in. Cash also is a real account. So here the entry will be cash account debit to machine account. How much? 10,000. Being machine sold. Okay, so with this we complete these 5 entries, and today was just a basic lecture to make you all understand how these different golden rules are used. One thing, the basic must be cleared. The first thing is, I have given a mantra, पारो दही से चाट बनाती है. पारो दही से चाट बनाती है. Remember, whenever we are purchasing, then purchasing is an expense. Purchase account is always debit. whenever we are selling, sales is always credit because sales is an income. Sales is the most important income. So sales is credit. Purchase debit, sales credit. One more thing you must understand. When the word is given paid and the word is given received, when it is paid, cash or bank, whenever you pay by cash, then cash will be credited. If you pay by check, then bank will be credited. Whenever you receive, when you receive, cash comes in, cash will be debited, or if there is check, then bank will be debited. So paid, cash goes out, cash is always credit. Received, cash comes in, cash is always debit. Paid, cash goes out, cash is always credit. Received, cash comes in, cash is always debit. Is this clear? Paid and received. Paid and received. This is purchase and sale. This is paid and received. These are the two important words. Okay. So I'll be posting the videos on journal entries. I'll be solving many problems on journal so that the basics of journal will be covered within 4 to 5 videos. Okay. Bye bye.